Welcome, everyone, to a brand new Bitcoin deep dive by MyCryptoParadise. Whether you've been navigating these crazy volatile charts with us since 2016, or you're just joining the ranks today, we are incredibly glad you're here.
Yeah, absolutely. Welcome to the Paradise family.
You are officially part of the family now, and our mission, as always, is really straightforward. It's to protect you, to aggressively protect your capital, and equip you with the exact analytical tools you need to thrive in these markets over the long run.
Which is a vital mission, especially in a space that is just constantly flooded with noise and panic.
With so much noise.
Right, and conflicting narrative everywhere. So our goal here is to cut through all of that and be your signal of clarity. We're going to navigate the realities of this market together, relying on actual data rather than emotion.
And today's deep dive is designed to do exactly that. We are opening at the playbook today. We're taking an exclusive, really detailed look into the latest internal analysis from our lead trader at the Paradise team, Simon.
Yeah, Simon's latest breakdown is just incredible.
It is. We're going to dissect his market insights. But honestly, this conversation, it has to be about much more than just, numbers or trend lines on a screen.
Right.
We're unpacking the fundamental mindset required to actually trade alongside the smart money.
Because that mindset is the definitive line between surviving crypto and mastering it. What we are really diving into today is behavioral science.
Yeah, psychology.
Exactly. We need to frame this core conflict that plays out on the Bitcoin charts every single minute. On one side, you have the professional, systematic, long-term mindset. And on the other side, you have the emotional, get-rich-quick gambler mentality.
The one that gets everyone in trouble.
Right. And the harsh reality is that the gambler mentality guarantees, with mathematical certainty, that most retail traders will eventually lose their entire portfolio.
It's brutal, but it's true. So let's jump right into the data Simon highlighted, because the current market context is startling. Right now, based on his insider metrics, we are seeing that almost 80% of retail crypto traders are feeling incredibly bullish.
Wow. 80%.
Yeah, 80%. They are aggressively buying as Bitcoin approaches a major historical resistance level. But wait, if 80% of the market is actively buying and feeling bullish, shouldn't we just follow the trend? Why fight that kind of massive crowd momentum?
It is entirely human to want to follow the herd, right? It feels safer in the crowd.
Sure does.
But if you look at how financial markets actually function, the crowd is almost always wrong at the extreme edges of a trend. When 80% of the market is heavily long, it means there's very little buying power left on the sidelines to keep pushing the price higher.
So it's a trap.
It's a massive liquidity trap.
Yeah.
Most people look at the market like it's a machine, just algorithms, math, arbitrary lines moving up and down. But Simon approaches this differently, utilizing a concept from Elliott wave theory.
Right.
He notes that the market is not a machine at all. It's a massive living organism. It's built entirely out of collective human psychology. And because it's a living organism, it has to breathe.
I love that analogy. So when someone says the market breathes, how does that translate to the actual chart we're staring at? What does a breath look like in terms of price action?
He describes market movements as inhales and exhales. The inhales are the powerful, impulsive motive waves.
The big green candles.
Exactly. On a chart, this is when you see those massive consecutive green candles. The market surges, the bulls take complete control, and they push the price upward with incredible force.
But you can't inhale forever.
You can't. Just like a human body, if you try to keep inhaling, your lungs will burst. Eventually, inevitably, the organism must exhale. Those exhales are the corrective pullbacks.
Right, the red days.
Yeah, and for the smart money, these exhales aren't just the market casually resting. They are calculated liquidity-grabbing events. The market exhales to intentionally shake out the weak hands, the over-leveraged long positions, before it can take its next deep breath.
That makes perfect sense. So looking at the current state of Bitcoin through Simon's analysis, he points out that we recently finished a definitive 5-wave structure to the downside. And following that, we've been in a massive inhale. The price has been surging upward, approaching that critical $72,000 mark. But how do we know if we're at the beginning of the breath or the very top of it?
That is the million-dollar question.
Exactly. And Simon uses a second analogy here regarding MACD momentum indicators, comparing the current market to a car driving up a steep hill.
The car analogy is essential for spotting those hidden traps that catch so many retail traders off guard. Imagine you're driving a car up a mountain road. The car is moving upward. The altitude is rising.
Right.
If you are a novice trader just looking out the window, which equates to only looking at the price action, you see the altitude going up and you feel fantastic.
Yeah, you think the momentum is unstoppable.
Exactly. But the altitude doesn't tell the whole story. What is happening under the hood?
So what are the professionals looking at then?
The professionals aren't just looking at the altitude. They are obsessively monitoring the dashboard, specifically the fuel gauge.
Like FCD indicator.
Yes. In this analogy, the fuel gauge represents bullish momentum, which, on a chart, shows up on the MACD histogram. Right now, as the price of Bitcoin, the cart creeps higher and higher up the hill, the MACD histogram is printing lower and lower highs.
So the fuel gauge is dropping toward empty even as the altitude increases.
Precisely. This is a classic bearish divergence.
Wow. So the car is still technically climbing, but the engine is starving for fuel.
And we all know what happens when a heavy vehicle on a steep incline completely runs out of fuel.
Gravity takes over.
Gravity does its job, the vehicle stalls, and then it rolls backward, often violently. This is why novice traders get completely wiped out. They see the green candles, assume the upward trajectory is infinite, and they hit the gas buying in at the absolute peak.
While the smart money is doing the exact opposite.
Exactly. The professionals at the Paradise team and the smart money across the industry are looking at the bearish divergence. They see the empty fuel gauge, start scaling out of their positions, and prepare for gravity.
And that brings us to the specific trap waiting at $72,000. Let's dive into the technical surrounding this, because Simon mentions that 72,000 is not just a random psychological number.
No, not at all.
It perfectly confluences with a 0.786 Fibonacci retracement level. For a listener who might think Fibonacci is just obscure math applied retroactively to charts, why does this specific decimal point matter so much?
It matters because Fibonacci levels, specifically the 0.618 known as the golden ratio and the 0.786, literally shape human emotion and decision-making.
It's hardwired into us.
It really is. You see the golden ratio dictating proportions in nature, classical architecture, and intrinsically in human behavioral patterns. When thousands of traders and the algorithms programmed by those traders watch a chart hit these exact mathematical proportions, it triggers something primal.
So these aren't just arbitrary horizontal lines drawn on a screen.
Far from it. They are visual, quantifiable representations of collective human greed and fear reaching their absolute tipping points. It's where buyers naturally become exhausted and sellers naturally feel emboldened.
It's as if the market's heartbeat hits a specific rhythm that demands a reaction. And at this exact $72,000 Fibonacci level, Simon is pointing out a very ominous pattern forming that mirrors the brutal market conditions we saw back in 2022.
Yeah, the green shooting star.
Right, the green shooting star candlestick pattern. Walk us through the anatomy of a shooting star. What is actually happening second by second to create that shape on a chart?
A shooting star is the ultimate visual record of a market trap. Let's say you're watching a daily chart. The candle opens, and the bulls are incredibly aggressive. They push the price way up past previous resistance.
A massive, powerful inhale.
Exactly. Retail traders see this giant green surge breaking out, and the psychological fear of missing out, FOMO, takes over entirely. They rush in, buying at the top of that surge because they're terrified the price is going to $100,000 without them. But then, right at the peak, near that 0.786 Fibonacci level, the hidden bears step in.
Ah, the institutional players who had their limit sell orders waiting patiently in the shadows.
They step in with immense, overwhelming selling pressure and push the price right back down to almost where the day started.
So when the candle finally closes, what you're left with visually is this massive wick on top and a tiny little green or red body at the bottom.
Right. And that giant wick represents all those retail buyers who bought the top and are now immediately trapped underwater.
It literally looks like a shooting star falling from the sky.
It does. And functionally, it's a violently bearish signal because it proves the buyers have exhausted their capital and the sellers are entirely in control of that zone.
What I found fascinating in Simon's notes is that it's not just the retail traders with a few $100s falling for this wick trap. He explicitly mentions that sharks entities holding between 100 and 1,000 Bitcoin, and even what he calls dumb whales handling billions of dollars, are getting trapped by these hidden bears right now.
Yeah, it happens all the time.
But why would a whale with $1 billion portfolio act like a panicked retail trader? Shouldn't that level of capital imply a higher level of sophistication?
You would assume so, but this proves a fundamental, unshakable truth about trading. Having massive capital does not equal having professional discipline.
That is such a crucial distinction.
You can be an early adopter who mined thousands of Bitcoin a decade ago, or an over-leveraged institutional fund manager. But if you lack a strict systematic process, you're still just a gambler. You simply have a larger bankroll.
Just playing with bigger chips.
Exactly. These sharks and dumb whales fall victim to the exact same behavioral biases. They feel institutional FOMO. They saw the price moving up, ignored the bearish divergence on the MACD, and bought right into the shooting star trap at 72,000. They let their emotions override data.
This perfectly highlights the MyCryptoParadise edge and the stark contrast between a professional mindset and a gambler's mindset. Simon noted that the live crypto fear and greed index is flashing a blazing 80 right now.
Which indicates extreme greed across the market.
Extreme greed. Think about the last time you saw a massive green candle on your screen. Your heart rate literally goes up. A rush of dopamine hits. You start calculating how much money you could make if you just bought in, leveraged up, and rode it to the moon.
And an 80 on that index confirms that millions of people are feeling that exact physiological response simultaneously. This is purely gambler's territory.
Acting on adrenaline rather than empirical data.
Exactly. People want to get rich quick, so they abandon their trading plans and start taking low-probability, incredibly risky trades. The truly dangerous part is that gamblers might actually get lucky in the short term.
Right. They blindly buy a green candle and watch their portfolio rise for a few days.
But because they have no systematic process for risk management, their bankruptcy in the long run is a mathematical certainty. One bad trade will eventually wipe out 20 lucky ones.
Which brings us to Simon's philosophy and how the entire Paradise team operates under pressure. Simon's core mantra is, think in probabilities, not emotions.
That is the foundation of everything we do.
How does a trader practically extract themselves from that dopamine loop and start thinking purely in probabilities?
It requires a complete rewiring of how you view the market. To think in probabilities means you fundamentally accept that you cannot predict the future.
You stop trying to guess what the market will do next.
Exactly. And you start reacting systematically to what the market is actually doing right now based on historical data. You establish strict rules for entry, exit, and capital allocation, and you do not deviate from them regardless of how you feel.
And this leads to Simon's counterintuitive truth about risk management. It completely redefines what winning means in this space. He points out that successful elite-level trading is not about winning 9 out of 10 trades.
Not at all.
In fact, his models show you can literally lose 9 out of 10 trades and still be highly profitable. Let's break down the math on that, because to a lot of people, losing 90% of the time sounds like a total disaster.
It sounds like a disaster until you understand the risk-to-reward ratio. This is the mechanism professionals use to mathematically guarantee long-term survival. Let's walk through a hypothetical scenario.
Okay, let's hear it.
Imagine you have a strict rule. You only take trades where your potential reward, your take profit target, is 10 times larger than your potential risk, which is your stop loss. This is a 1 to 10 risk to reward ratio.
Got it.
If you risk $100 per trade and you lose 9 trades in a row, you are down $900.
And a gambler would absolutely panic at that point.
A gambler would panic, revenge trade, and lose everything. But the professional stays calm. Because on the 10th trade, when the high probability setup finally executes perfectly, they make 10 times their risk.
They make $1,000.
Exactly. Even after losing 9 times out of 10, they are still up $100 in net profit. For a professional, losses do not trigger an emotional crisis. Losses are just data.
The cost of doing business.
They provide immediate feedback from the market to help sharpen the next entry. Wins are not a stroke of luck. They are just the natural, inevitable result of disciplined execution over time.
Losses are just data that completely neutralizes the sting of a red day on the charts. And for you listening, this is exactly why MyCryptoParadise exists. We know how incredibly difficult it is to maintain that robotic discipline when your hard-earned money is on the line.
It's the hardest part of trading.
It is. Simon made a promise in his analysis that really encapsulates our entire ethos. He stated, "We would rather miss a trade or two than risk your capital unnecessarily."
That is the ultimate pledge of trust we make to the Paradise family. We operate with the strict clinical parameters of a top-tier hedge fund. We have a team of elite traders monitoring the order books, the on-chain metrics, and the momentum indicators 24/7.
Doing the incredibly boring, tedious work.
Very uncomfortable work sometimes. We stare at the charts for hours, waiting for multiple time frames to align, constantly calculating and recalculating the minute details of risk exposure.
So our listeners don't have to act on emotion.
Right. We absorb all of that heavy lifting and data processing. We provide the signal so you can protect your capital and build lasting wealth.
With all of that professional discipline in mind, what is the actual trading tactic right now? If 80% of the market is screaming buy, what is Simon doing with his own capital?
Right now, he's waiting.
Well, the tactic is actually just sitting on his hands. He noted that the market is currently trapped in what is called a WXY double three formation. What does that mean in practical terms for the price of Bitcoin?
Translating that from Elliott wave terminology, a WXY double three formation essentially means the market completely lacks a directional motive. It's a complex corrective pattern that chops sideways.
No clear direction.
Right. The bulls do not have the liquidity or the strength to push a true new inhale, but the bears haven't yet committed enough volume to start a massive cascading exhale. They're just negotiating in a tight range.
And when the market is chopping sideways without a clear definitive motive, a professional trader does nothing.
You preserve your capital. You do not force a trade when the market is refusing to give you a high probability setup.
So we wait.
Right.
But we aren't waiting blindly. Simon laid out two very clear, data-driven scenarios for what happens next. Let's start with the bullish invalidation.
Okay.
For Simon to shift his bias, abandon the bearish divergence theory, and start longing Bitcoin, what specific chart actions does he need to see?
He needs to see a massive, undeniable new inhale. Specifically, he wants to see 5 distinct, powerful motive waves to the upside on the lower timeframes.
So not just a quick wick?
No, the market cannot just wick above resistance. It has to push through, reclaim the $70,200 level, and turn it into solid, tested support. Then it needs to completely shatter that $72,000 Fibonacci resistance wall with high volume.
And if that happens?
If all of that happens, it means the algorithmic sellers have been defeated, the fuel gauge is full again, and entering long positions with targets towards $76,000 becomes highly viable.
But as professionals, we have to weigh the probabilities. And currently, based on Simon's models, the higher probability scenario is bearish.
It is.
If that $72,000 level acts as a brick wall, which the historical data and the declining MESID volume heavily suggest it might, then the car finally stalls out. Gravity hits. The third wave exhale begins.
And Simon warns this won't be a gentle 5% pullback.
No. He projects this could violently drag the price down to the $54,000 area.
And if it drops to $54,000, that is likely just the first major pit stop. Ultimately, the target for this massive market exhale would be the $44,000 support zone.
Wow. 44,000.
This is a crucial area to monitor. The $44,000 level is a psychologically massive multi-year support structure. It's the exact zone where the real smart money, the highly disciplined institutional whales who did not buy the top, are eagerly waiting.
They have massive limit buy orders pooled down there.
Cooled at 44,000, just waiting for the impatient retail gamblers to panic, capitulate, and sell their bags to them at a massive discount.
So, synthesizing all of Simon's analysis, what is the ultimate takeaway tactic for you right now? It is pure, unadulterated patience. You have to actively detach from the outcome.
Do not let a fear and greed index of 80 trick you into rushing the gates out of FOMO. Let the gamblers play their dangerous games.
Exactly. Respect your risk management, preserve your capital, and wait strictly for those high probability setups that Simon and the Paradise team are watching for.
If we pull back and look at the core lesson of everything we've dissected today, it comes down to this. True success in crypto trading isn't about perfectly predicting the future with a crystal ball.
No one can do that.
Yeah.
Not even the smartest algorithm.
Success is entirely about mastering your own psychology. It's about managing your risk so aggressively and systematically that a series of losses doesn't even make you flinch. And it's about having the cold, hard discipline to wait for the market to come to your levels, rather than chasing after green candles like a gambler in a casino.
That reframing changes everything. If success is about mastering your own psychology, it fundamentally changes how you look at a red day or a missed opportunity.
It really does.
And for you listening, remember that you are not doing this alone. As a valued part of the MyCryptoParadise community, you have an entire team of dedicated experts in your corner. We are here filtering out the noise, keeping the emotional panic at bay, and helping you trade with a calm, clinical, professional mindset.
Before we wrap up, I want to leave you with a final lingering thought to mull over as you watch the charts this week. We talked extensively about how the market is a massive living organism built entirely from human psychology.
Right.
So consider this. Are the charts we stare at every day actually showing us the intrinsic mathematical value of Bitcoin? Or are they just a mirror, perfectly reflecting our own internal daily battle between patience and greed? The next time you feel that sudden burning urge to rush into a trade because the price is moving fast, stop and ask yourself, are you seeing the market clearly, or are you just looking at a reflection of your own unchecked emotions?
That is a powerful question and definitely something to chew on as we navigate this resistance level. Thank you all so much for joining us for this deep dive. Stay patient, stay disciplined, and above all, keep your capital safe out there in the markets. We will see you on the next deep dive. Cheers, everyone.